Let me start by saying that, investing is all about risk taking. So if you are taking risk, not with your basic amount of money that you have to run the family or run your business, as the case may be. You are taking risk with your surplus money. Now that surplus money, what is the level of risk that you can take? How far can you go? The first question that comes to all our minds is that I have this surplus, can I take this kind of risk or not? Now that is when the question comes, if I need to do it on my own, or should I hand it over to a portfolio fund manager or to somebody like professionals like Feroze and his team. Let me now start with the first point that Feroze made, is the inflation issue. There is always a dichotomy between, like he rightly pointed out, the inflation for an individual is different from the inflation for the country as a whole. But then the policies of the country are set by not my inflation levels, but they are set by the country's inflation levels. So for example, as you rightly pointed out, for some of us, the inflation could be 10%, 12%, and even it could be even 15%, depending on whether you're in Mumbai or in a small town or some other place. But the general inflation level, the consumer price inflation level, right now the government and the RBI are taking is the retail inflation level based on the consumer price index, which is an average of both urban and rural consumption. There, it's trending low. It's just 3%. In fact, the latest numbers is much below 3%. So fruits, vegetables, food, wheat, rice, the groceries, as you pointed out, they are all very cheap. They don't matter to us. They may not matter to an HNI. But what matters to the HNI is the policies that are made based on that 3% inflation level. Now that is where your returns will be determined, whether it's in equities, whether it's in debt, or whether it's even in real estate for that matter. Now when the interest rates in the economy change, interest rates are based on the inflation level that the RBI targets very clearly, saying that, look, inflation should not go beyond a certain comfortable level. Till 6 months back, the RBI was worried that inflation is going to be high. We have risks to inflation because oil prices were going up. Suddenly, it's a blessing in disguise. Oil prices internationally have come down. They've come down to such an extent that now the RBI has changed its view on inflation. When it changes its view on inflation, there's a lot of noise that we make around the policy decision. It does not affect you immediately. It does not affect an investor immediately. But then the interest rates are on a downward cycle. So if your investments, debt part of your investments were earning, let us say on an average 9.5%, now it may not get you the same 9 or 9.5% going forward, because inflation has come down and RBI wants to reduce the rate in the economy, bring it down. Your returns from that investment may go down to 8 or even to 7.5 if the same kind of trajectory continues. Now that's as far as the direct relationship between inflation, interest rates, and the return on the debt part of your portfolio. Now the indirect impact comes into the stock markets. So when interest rate, the return on interest rates or the debt investments keep going down, people tend to look at equities for higher returns. That's what he explained, when you should target 15%. So when money moves from one asset class to the other, there are some major shifts happening in the markets, which is beyond the control of even the best of the institutions. You just can't manage this. I'm talking purely about the domestic economy and the domestic factors. Now bring in the global factors, they are far more complicated, far more volatile. Just look at the US. It has got the longest bull run, more than almost 9 years. Everything was rising there. Equities, your bond yields, and dollar itself getting stronger. Suddenly that's coming to an end. And there are also exaggerated fears that there are some technical tools, measures that they have adopted, which indicates that there could be a recession going forward. Now when this happens, money starts moving away from the US to markets in India, markets in China, and other emerging markets. So the movement of money is another variable which is very difficult for us to control and predict as individual investors. That is the second dimension. Now, the third and the more apparent and very clear uncertainty and instability that we are all facing is the political uncertainty. 3 state elections, in all 3 key states, BJP has lost. The question arises is, will they continue to stay with the same kind of confidence? Will they be able to make it in the next elections 6 months down the line? Now, these are big questions. They may or may not affect your investments right now, but going forward, they are going to affect your investments. So it's not as if that we have to quickly, we are not institutions, HNIs are individuals, they are not institutions to move money from here to the other. But then it's very important to review the investments and say, look, do I need to add more to this asset? Do I need to reduce some other asset? Now, let me use that as the starting point, Feroze, because this is a question for most investors to review and say that, look, am I doing good? What next for us?
See, I think, of course, review on a frequent basis is critical. Should you take action or not is a separate story. Review is critical. If mistakes are thrown up, then action is required. So now, of course, there are going to be uncertainties. We are going to always have situations where events will keep happening. Right? One thing which is certain, and the only thing which favors you all the time, okay, only one thing is compounding. Okay, what do you mean by compounding? Because your return also grows along.
Absolutely.
So time is the only variable which is in complete control. There are all other variables which might be external.
Exactly.
Nobody can put a gun on my head and say you will be staying invested only for 2 years. It's going to be my decision. If it is going to be my decision, then what is that one variable which can favor me? Which is compounding. When you do a lot of market timing, getting in and getting out, which traders do, sometimes investors also look at traders and follow suit. Compounding becomes your opponent rather than your friend. Now let me give you an example to tell you the power of compounding. Compounding is return on return. Now let's assume if I gave you a choice that I give you 5 crores as a gift today or give you 1 rupee as a gift today. With this statement, of course, anybody will say give me the 5 crores. If I told you this 1 rupee has the power to double every day for the next 30 days. It is compounding, it will double every day. Take 1 rupee, keep it around, it will double. The next day it will again double. Which one would ideally people choose? Is the 5 crores. Ideally, when I've asked this question. 1 rupee doubling 30 times. 1 rupee, single rupee doubling 30 times means it will become 53 crores. 1 rupee doubling 30 times becomes 53 crores. You can use a calculator to see. It's a single rupee. So the point I'm making is, what is this big distinction? This is compounding. Right? So compounding is a very important variable and that comes with time. So I always urge investors to not be coming in and going out too frequently. That's point one. Review is important. When you're doing a review, you have to do a review on asset classes and sometimes use all the tools available in finance which may or may not have reached you. Okay, in situations which Murali Saab said, saying that election is coming. If election is coming, is there some armory in my bag which makes me go through this election in a smoother fashion? Even if BJP comes or it doesn't come, how does the market react? Nobody knows. Right? So is there a vehicle which can help me sail through this small little speed breaker more smoothly? Yes, there is. What is that vehicle? Now, at least on my personal portfolio, I will use that vehicle for that period to have a relaxed life. So, review and usage of contemporary relevant financial instruments which may not have reached you. Like one of them, which helps you sail through these big events very well, is hedging your equity portfolio. Don't come out of equity, hedge it in the most effective fashion. You can hedge it in the most effective fashion. So something which is relevant today may not be relevant tomorrow. So review it. Once you review it, you have to also see what is most contemporary financial instrument you can utilize to sail through one of the bigger events, which I'm sure has a lot of emphasis.
Absolutely. A review is important. Feroze, we also assume every time, whether it's on our channel, in panel discussions that, many analysts keep advising viewers and investors. The assumption is that they are sitting on cash. I think if their portfolio value is 100 out of 100, I don't know how many people will sit on 100 as cash. So that becomes very difficult and it confuses viewers also. What should I do now? For somebody, let's say, who's got 100 invested fully in different asset classes. Now, how does one move from one asset class to the other in a situation like this? See, for example, I said interest rates are falling. When interest rates are falling, the typical textbook theoretical model would say that you move from debt to equity. Okay, now these are difficult decisions that are done. I'm sure you have a large team of advisors who would advise you. But to simplify this for the audience, how should they move from different asset classes? Is it necessary? And if it is, how to?
So I think it's a very practical question. We advisors very easily say 50 equity में डाल दो, 50 debt में डाल दो, या फिर 30 real estate में रखो. That is assuming that we all are sitting on 100 rupees, all our 100 rupees in a bank account. It doesn't happen. So I think I appreciate your practicality in this question, saying that if I'm already fully invested and if events come and go, do I need to make any change? And if so, how? For which you need to have an idea of three things. One is, what is the asset allocation? What is the product choice? See, every asset, what are the assets? You have four assets: equity, debt, gold and real estate. The rest of it is all distraction. These are four assets. Asset of growth, जिसमें बढ़त देखने को मिल सकती है, those are equity and real estate. Gold and deposits, as they are more popularly called, are safer assets. First, you have to understand what is your strategy allocation in each of these assets. Then in each asset, in equity, you can participate by buying a stock. You can buy a mutual fund. You can buy a PMS. Out of 20 years of history, which is the strongest vehicle? That choice should be clear in my mind, saying that I think to participate in equity, I will never use direct equity for somebody, right? So vehicular choice should be crystal clear, right? And then you need to get into implementation as the third step. So point taken that you don't sit in cash, so transition will happen. That is why when we defined the 4 steps of management: objective, strategy, implementation. Even if you wish to exit your real estate, will you be able to exit it in 2 months, 3 months, 6 months? May not be for 1 year, 2 years also. We gave a negative view on real estate 5 years back. Okay, and I'd written one article, and then I almost had a very, very nasty conversation with a builder 5 years back, right? My clients have still not been able to exit it, some of them. So implementation, strategic decision to implementation could be years away. But I think putting a balance sheet together is very critical. Share it with a person who is your confidant, if not Anand, Rathi, whom you think can give you advice, unbiased advice, and then go on to strategy creation and then implementation. So share your balance sheet with a person whom you think can give you a good advice. Of course, being in Anand, Rathi, I'll say you can share your balance sheet with us. But yeah, it's your choice, but you need to see who can give you unbiased advice. Go to that person, share the balance sheet, and then devise a strategy and then implement it, in my opinion.
Absolutely. It's always important to keep reviewing the portfolio, because the general assumption in the markets is that a fund manager would always say, stay invested for long term. Long term could be 10 years, 15 years, 20 years, and everyone needs money at different stages for different purposes. Creation of wealth is not just for the sake of wealth creation, I suppose. It also serves particular requirements, whether it's buying a house or going abroad, education, as the case may be. I'll just add one point to this issue of fund managers holding large number of stocks. Small cap funds have been very, very popular, over the last couple of years, simply because they were giving 30, 35, 40% return. Now, in the last 1 year, they are giving negative return of the loss is 30%, 25%, in some cases even 40%. But a good small cap fund manager does this. What they do is they pick up some of the funds have 100 shares in them. And in each of them, they don't have an exposure of more than 2% or 3%. So they spread the risk. At the same time, over a period of, let's say, a small cap company, the assumption is that you should not hold for more than 5 years because their ability to survive in a market is something which we don't know. So typically that evens out and gives you a much higher return than a large cap fund. Now that's point number one. Let me come back to the question of, let me move slightly away from equities and say if somebody wants to have all asset classes, would you recommend a structured product where you structure in such a manner based on the risk and the objectives that you have set, 15% or 18% as the case may be? What is the structured product and how should one invest in it?
Correct. So Anand Rathi believes in only two products. So one is mutual fund, the other is structure product, and there is reason for it. Okay, and the third thing is we hedge people's portfolio. These are the only three things we do. Hedging a PMS is practically an impossibility.
Yeah.
Hedging a mutual fund for me is far easier. So an instrument which I can't manage my risk, I don't want in my portfolio is the third reason why I would not buy PMSs, which I didn't recollect at that point in time. So structure product actually has a standard deviation, or like when we said risk, Nifty is 13, PMSs are 18, 19, 20, structure product is 6 on risk. Nifty is at 13. If a structure product gives me a risk of 6, that means if I can make 16, 17% return with a 6 standard deviation, it is called standard deviation, the risk measure. Okay, Nifty is 13, structure product is 6. So structure products help me reduce risk of a portfolio considerably because measured risk, which people don't measure, is 6 or 7 for structure product. For PMS, it is 18, 19. For mutual funds, it can range between 11 to 14, 15 also. So structure product is nothing but a plan B. Structure product is a plan B. Whenever an advisor creates a portfolio, he can fall into this trap that I will go right all the time, which will never happen. Feroze will never go right. Even any advisor ideally cannot plan the client's portfolio assuming that I will go right. There will be situations I will go wrong. So there is going to be plan A in the portfolio. There will be plan B in the portfolio. In our opinion, you have to construct the portfolio as plan A and plan B. If advisor goes right, plan A, great. If he goes wrong, my client, I can't tell my client, sir, I went wrong. So you made no money anywhere.
Yeah.
So both of them have to complement each other. So what is structure product? It is a component of or a constituent of portfolio construct which can be used as a plan B or a fallback option in bad markets. For example, last 3 years has not been an exuberant market. 2017 was a good year. Again, 2018 was a bad year. 2015-16 was a bad year. So mutual funds gave 6%, 7% for last 3 years. Our structure products gave 17, 18%. Now, it looks like structure product is great. So client says, why don't I put all my money in structure product?
Right.
There will be a time when structure product will underperform mutual fund. Both will act as opponents and complement each other to make a more robust portfolio. Right? Structure product says, if the market gives you 2% every year, I will give you 17% every year. Or something like that. If the market gives you 4% every year, the product will give you 17% every year. But it will never give you more than 17. The fine print is you are stuck at 17, maximum 17. So for some portion I cap my return, so it becomes a plan B. So the question to ask ourselves is, should you have a plan B? If so, which portion of my portfolio is a plan B? If you don't have a plan B, introspect and see whether the portfolio design requires a fallback option. When you on a Sunday go to a restaurant and you take a fallback option, yahan reservation nahi mili to wahan jaunga. Does investment need a plan B? If so, what is your plan B? If you get an answer to it, great. If you don't have an answer to it, in our opinion, we deliberated a lot 7 years back and said structure product will form a part of client's plan B. And it has helped during bad times. In good times, it will look like a stupid decision. In 1 year, mutual funds have given, like sir said, na, 40% return.
Yeah.
That time when you're stuck at 17, it will hurt you. Saying that, kya yaar, Feroze, तूने structure product दे दिया, वो 17 पे cap हो गया. But ठीक है, ये अच्छा चलेगा, तब ये 17 से ज़्यादा नहीं देगा. जब ये बुरा करेगा, the probability that this will give you a higher return will be, there will be a balance between both of them.
Insurance and risk. At various levels, we face this question. We start by saying, I have to cover my life, we have to cover this risk, we have to cover that risk, and then there is no clear-cut approach when it comes to insurance. There was also a phase when there was a lot of confusion when companies started marketing unit-linked insurance plans. That was a package of insurance as well as investment. Insurance is insurance, investment is investment. So that created a lot of confusion, and the regulators had to come in and segregate because in a ULIP you end up neither investing nor covering, and you end up losing money. In both ways you end up losing money. My question to you is, how does one approach insurance from all aspects? Life cover, health, taking care of insurance against the risk of your business, risk of investing, and the household products or car or what. Car, of course, is mandatory. Would you like to throw some light on that?
Of course. I think insurance is a risk mitigant. Insurance is a risk mitigant, should be used only as a risk mitigant. Can a risk mitigant be used as a return generation? Effectively, to my mind, no. Now the problem is, we have some relatives who have become insurance agents, or if my banker is giving me very good service, he will say, sir, insurance kharid lo. Demonetization ke baad, I got 2 of the bankers who said, yaar, I gave you so much cash, you didn't have to stand in the queue, give me 3 lakh insurance. I said, yaar, if you have bought it for your uncle, for your dad, then give it to me. I won't even speak. Ask my colleague, she'll cut a check to you. But if you have not bought it for your dad or your brother or whoever, some relative statement you bring, then you take. Nobody. I've interviewed 400 relationship managers to hire 100 in the last 4 years. I have asked this question saying that client ko insurance diya, papa ko diya. Bolta ULIP nahi diya. Right? I don't know how can I morally look into a person's eye and say it is very good for you. Deep down I know that it is not. Right? That's why I don't buy it for him. So now the problem is, in obligation I would have bought. I have also bought insurance policies. One of my cousins became an insurance agent. She called me 3 times. I said I have to support her. Yeah. So I bought 2 lakh insurance policy. But now, fine. Should you now do an audit of all your insurance policies?
Exactly.
Audit them, because so many things have changed. What changes? Your objectives change. The regulation changes. Earlier, insurance policies, when I used to work in ABN AMRO Bank, has given my company 70% commission. Now at least there is 30% cap. I'm so happy, right? That now that's capped. So now, are they still relevant? So put all your insurance policies, get it audited. I have a team of people who only audits insurance policies and helps people exit it profitably, not sooner, not later. Right? So get them exited, put that money to good use. 2,000 insurance policies which we audited, which had finished 10 years of investing. Not short term, 10 years of investing, average return is 5.67. 2,000 live insurance policies. Now if 5.67% is going to be my return, and if my client is still having 20 lakhs, 30 lakhs, 50 lakhs, it might be a very small amount, probably sometimes. That is what it will go unnoticed. Clean that, bring it to mainstream. But having said which, is insurance a very bad tool from risk mitigation? No. Today you can get a life cover at 14,000 rupees for a 35-year-old man. 14,000 rupees, 1 crore. 1 crore of life cover can be got at 14,000 rupees. So should I buy myself a 5 crore life cover? Maybe. Spending 70,000 rupees a year, and next 30 years, if I paid 15,000 rupees into 75,000 rupees, if I have a 5 crore cover, in the next 20 years, I'm going to be paying how much? There will be? Yeah, 15 odd lakhs. If I die once, I get 5 crores. Right? So that's going to be a good risk mitigation. So should you buy term plans? Term plans are simply wonderful. Health covers can help you bring down your inflation. When we kept saying inflation is high, medical inflation is 17% in India. 17%. India is very low on medical cost. US, same cancer treatment, which one of my cousin went to get there. Here in the best hospital in India, it was 5 lakh rupee, 3 chemotherapy cycles. He went to Texas, Dr. Anderson Hospital, 8 crore rupees was the bill. Right? So we have a large catch up to make. 8 crores for 3 chemotherapy cycles. 1.3 or 1.4 million dollars at that point in time. So we as Indians, because there is no insurance for all the garib, now if Modi ji implements that plan, all poor people will be insured. So hospital bills will go up. If you bought yourself 1 crore health insurance, if I get hospitalized, 1 crore expenditure doesn't hit me, right, your inflation will automatically come down. So I am clarifying that insurance is a very important financial instrument. Problem is using them for investments under the garb of ULIP and endowment plans is not good. And it is very detrimental to people, and you would have lost a lot of money already. If not already, you will lose if you stayed the course. So get your insurance audits done. I think that is something which I have seen wherever I've done an insurance audit, exited, मुझे दुआ मिली है कि भाई तूने फिरोज ये किया था काम. अच्छा. 10 साल बाद.
Okay, I think the that's the last question, and last question is the most important one about insurance cover. Use it only to cover the risk. Don't use it as an investment tool. That's a very clear message. On that note, I think I will close this conversation and throw open the session to Q&A. Please introduce yourself and shoot the questions.
Hi, my name is Vijay. I am a client of Anand Rathi. I will request you to express your views on Contra funds, one. And second is, please explain this side pocketing of mutual funds which is being mentioned recently.
Contra funds. See, what happens is, you have, what do you mean by a contra fund? So for the benefit of the rest of the group, to fill them in if you are not already aware, is if the market is going in one direction. Now for example, pharmaceutical stocks have not run up for the last few years. Pharmaceutical companies होती हैं, वो ऊपर नहीं गई थी. If a fund buys those companies which have not gone higher, then as the name suggests, he is doing something contradictory to everybody else. That's called a contra fund. So it's a theme. So what I'm trying to say is, contra funds could be good if they are true to label. Unfortunately, it's very difficult for a fund manager to stay the course of contrary investing. They fall for the trap of herd mentality. So I personally think you should classify funds only in 3 broad categories, and you can live your life with those 3 broad categories, which are large cap funds, mid cap funds, multi cap funds, and to a certain extent small cap funds as well. So 4 categories. There are 10 possible categories which SEBI has now defined. So SEBI has, to benefit all of us, reduced the clutter and said there are 10 categories of mutual funds. We focus on 4 of them. You can choose the right fund from these 4 categories, and I don't think you will miss much. Because I have seen 3 contra funds and analyzed them very extensively, and I sensed a behavior of herd mentality even in a contra fund, because the investors are not patient. A contra fund, you need to stay invested for 5 years. But if performance doesn't come for 2 years, the investor anyways goes away. So the fund manager knows that I will not get 5 years. So that's my opinion. Now, very importantly, now that we are on the, so let me cut my answer short. Let me go to the second part of your question. What is side pocketing? See, any changes which impact you and me, even if they sound more complex, it's our duty to know. What is side pocketing? Is when you buy yourself a simple fund of deposits or debt investment, जिसमें risk कम है. Debt fund वो होता है जिसमें हम फंड मैनेजर कंपनियों को उधार देता है. सिंपल कॉन्सेप्ट है. अगर एक कंपनी डूब जाए तो वो उधार के पैसे वापस नहीं आएंगे. So what was happening is some people were exiting the fund sooner and they were saving themselves. So there was an unfair difference between people who stayed back and people who went away. If I'm a very smart investor, I know that this company has defaulted. I remove my money. The rest of them who are staying inside the fund might unfairly be demerited. There could be an advantage or disadvantage. So to make sure that there is no advantage to a certain group and disadvantage to a certain group who are in the same fund, side pocketing is a concept which helps you save this problem. How? Because as soon as a company becomes bankrupt, like ILFS was one company on September 3rd this year, which was supposed to be a very strong company, suddenly went default. So if it happens again, they will take that bond and put it in a side pocket. That's why it's called a side pocket. Now anybody who exits also will have a share in the side pocket. So side pocketing is a mechanism to make sure that there is no unfairness to people who stayed back and who went away. That is more important. How do they achieve it? By taking the bad bond and putting it in a side pocket, which is segregated from the main good portfolio. So they segregate bad portfolio and good portfolio. So a person can only redeem his share from the good portfolio, not from the bad portfolio.
I'm Chabra. I really have two questions. Number one is regarding the structured funds. What percentage of your portfolio should go in structured fund? And within the structured fund, what should be the correlation between the debt and equity? Right?
Okay.
And of course, you will tell us what is the return to expect. The second question is with regard to objective 1C. I think while you keep educating us on 1A and 1B, 1C is an area which is slightly, we are not being educated enough. So maybe before the financial year ends, it may be a good idea to expose us to that, because then only that's a very important field, which you have correctly identified, but unfortunately, that 2% we'll not like to lose. Okay? Thanks a lot.
Super, sir. So to answer the pointed question, how much should be in structure product? To my mind, structure product should, from a client's perspective, not exceed 35 to 40% of one's portfolio. To be honest, my money is 55-60% in structure products. Because I've been doing it for 10, 12, 14 years, from 2006 when it has been in India. So that is clarity emerged over long periods of time. A client should restrict it to 35 to 40%. The split between debt and equity should be whatever is your equity allocation. If your allocation of equity is 60%, 40% of that should be equity structure. So whatever is your equity allocation, 40% of the equity allocation, which is 24 rupees, should be equity structure. If your 40 rupees is in debt, 40% of 40 rupees, which is 16 rupees, should be in structure.
I'm Sanjeev Ogle. In your opening remarks, you mentioned something about mistakes made by the investor, and I would like to know the mistakes part. Can you expand on that? Mistakes that are created by the wealth managers also, or the investors also?
Correct. So हम तो गलतियों के पुतले हैं actually. So I can go on and on what mistakes we did. The only part is learn from your mistake. As long as I can learn from my mistake, I know I'll not be doing the same mistake 10 times. But mistakes to hogi. To give you an example, long back we had learnt a mistake. We had done a mistake. We relied on rating 6 years back of a company, and that went bankrupt. AAA देख के हमने लोगों के पैसे डला दिए. AAA rated company है, and we said this money can't go anywhere, but that went default. So my client's money went down the drain, and then we went through litigation. Only 70% of the money came back. If I do the same mistake in 2018, which was done in 2011, then it was not worth losing the money. So what did we learn from that? We said we will not only rely on rating. Back then if I don't rely on rating, then what else do I rely on? Right? So we stopped believing in rating, is why Anand Rathi's structure product, we didn't take a rating. It's a big message to give, saying that I don't believe in rating. Why? Because AAA rated company overnight went default. That's the biggest crime a rating agency can do to people who are relying. And again, it happened so many times in the last 7 years. And the latest was September 3rd. AAA rated company went default. Single day. It is like crazy. If I don't learn from this mistake, then what else will I learn from? So mistake one, which we did, not others, we did. As Anand Rathi was rely on rating and lend our clients money to that. It went default. So we started 6 years back using another formula to evaluate the strength of a company, which is called Altman Z-score. Altman Z-score. Very, very good formula, which tells you whether this company has a chance to go bad or not. Altman in 1968, one scientist, Harvard professor, invented this formula. So this formula is so strong that it will tell you 2 years before very well that this company is going down. Get out as soon as possible. If I give you an example, 2 years back, 1.5 years back, a company called Amtech Auto went default. That was AA for 4 years. Altman Z-score said a completely different story. Rating said the same story for 4 years. It is AA. Suddenly one night, default. Altman Z-score, on the other hand, said 2.8 first year. 2.5 ke upar is very good. Anything above 2.5 Altman Z-score for a manufacturing company is very good. So Amtech Auto, first year how much? 2.8. Is it good? It is better than 2.5, thumbs up. Next year, 1.29. That means that it has slipped below 2.5. The next year, 0.32. Fourth year, minus 1.2. Altman Z-score clearly exhibited that this company is deteriorating. Rating was not changed even one notch for 4 consecutive years. So mistake one, to illustrate, don't rely on ratings, is one thing which we wrote down in our book as a learning, which I remember clearly because I have been reminded very recently, is why I'm giving you this illustration. This is not the only mistake, we did some other mistakes as well, but we learned from it and tried to make sure that we will never repeat it. So in our organization, we write it down saying that this, even if I am no more there, if 20 years from now, these learnings are written down and followed.
Hello, Feroze. This is Jay, and thank you for a wonderful session thus far. So if I look at your 4-step academic wealth management process, the first one you suggested is to have a target. The problem with having an absolute target is I keep setting targets and I always come up short. And the explanation is always that, you know, the global events and the market dynamics this year are different from what it was in the previous year, right? So would it be better to set a target which is with a reference to a benchmark and say that, okay, I'd like to achieve a target of so many percentage points over and above that particular benchmark? And if that is the case, you know, the 4th step in your case was a monitoring and of course corrective action thereof. We have no ability to either monitor, assess, understand market dynamics and take corrective action. And whereas wealth managers like yourself would be able to be in a better position to assess the impact of global events and translate that into an impact to my portfolio. So if that is the case, would it be right to engage in a conversation with a wealth manager into saying, can you promise me certain delta, certain alpha over and above the market benchmark, and then work towards achieving that?
Wonderful. So we debated a lot before we came to this objective of 15%. Should it be plus or minus something, or should it be 15% absolute? Okay, so what is right for my client? So we debated it. Of course, 15 might not be consistent. Since all of us spend in rupees, my target has to be in rupees, is what we were debating. We debated this good for 3, 4, 5 months, saying that should we have a relative target or should we have an absolute target of 15%? We should have an absolute target of 15% is what came out of the debate. Because tomorrow if Government of India gives me 16, I would say I don't want to take any risk here, provided inflation is not at 20, right? Since inflation is not relative to Nifty, my client is spending money not relative to Nifty, his target, for me, a simpler job is to make it relative. Actually, from an advisor's point of view, what you're saying is far more simpler to track and deliver. It is simpler. I'm not saying very, very easy, but it's relatively simpler. From a client's perspective, Nifty 20% down hai. If I told him you are down 15, but he is still lost in rupees, should we together have a 15 target? How to achieve that? On a 3-year rolling pocket. On a 3-year rolling pocket is not a very, very tough task, provided we go through the strategy which I'm proposing. Okay, so I'll come to the point. First point is, ideally from a wealth manager's perspective, what you're saying, it is very good, sir. It becomes easier for a relative comparison. But if I think from client's perspective, client bolta hai, mera kya lena dena yaar? Market is 20% down, I am down 15. I won't party because I've lost 15. Most clients said that, right? Sophisticated clients will say, no problem. If market fell 20, Feroze, you lost me only 15, I'm happy. But if I have to create a target for 99% of this room, then I would choose 15, not a relative target, right? So that's point one. How to achieve it? Firstly, have a strategy. So either my strategy, your strategy, have a strategy and backtest that strategy for the last 30 years. Backtest that strategy, saying that if I did the same ghisi-piti strategy for every day for 3 years, how many times would I have made my 15? If the answer comes half the time you made 15, half the time you didn't make 15, then that is not the right strategy. Then you are better in a casino, right? Because 50% chance is there in casino. Red आएगा या फिर black आएगा. 3 minutes में पता तो लग जाएगा. 3 साल wait क्यों करूं? So point one I'm making is have a strategy. Choose a strategy after back testing it for 25 years. Of course, future could be very different. But at least check whether 80% of the times, 90% of the times your objective is met. Then you can imbibe that strategy. So we checked the strategy and we did a lot of debate and came to a strategy saying that this will 90-95% of the times deliver you that 15% expectation on a 3-year rolling. Like 2018. 2018, this financial year, are my clients making 15%? The answer is a big no. Are they losing money? No. They are at 2%, 3%, 4% IRR. Does it worry me too much? No. Because half of BSE stocks are for 30% down, 40% down. Like Maruti stocks sir mentioned, na? It's 35% down. Half of the Bombay Stock Exchange 4,000 stocks are 30% down. In that situation, if my clients have made 3-4%, I know 1 year will come, well, they'll make this gap of 11%. So that's why I'm giving a disclaimer saying that 3-year rolling mein 15% banana with 8 ki standard deviation. That is the key. 8 ki standard deviation. 13 ki standard deviation nahi, 20 ki standard deviation nahi. 8 ki standard deviation, 8 ka risk. So that is, so I urge you to share your balance sheet, go through the strategy. If you don't like the strategy, tell the guy, just because you've spent 3 hours with me, I will not follow your strategy. This is my 30 years money, 20 years money. But no obligation. Strategy, understanding is a good idea.
Hi, Feroze. Abhimanyu.
Yes.
And Anand Rathi is my client. You spoke about strategy, you spoke about opinion and investment. How do you ring fence yourself from all the noises going around and ensure that my investment is protected? Because you also operate not in isolation.
Correct. So we had learned something that we wrote down. Am I a company which is helping traders, or am I a company who is helping investors? Investors need trends. What are the trends? Like technology was a trend. which if a person caught on earlier, he created an Uber. It was a trend, right? So the job of wealth managers who are advising investors, the job is to trend ki pakad rakhni padegi. Trader, like we have another outfit, we are one of the largest brokers. They might be addressing that group of people, which is not my division, is addressing traders. They need to catch the direction of the market. Market की दिशा को पकड़ना है. Investor के लिए market की trend को पकड़ना है. So we bet on trends rather than direction. So anything which is going to dictate direction, I say I'm not interested in even hearing. For example, okay, I am not worried whether interest rates will go down in the next 6 months, 1 year. Because they have been going up and down. So that will always be there. So that is not what will change my strategy. If mutual funds regulation, new regulation stops all mutual fund inflows, then I will say a trend has changed. Indians are investing now in mutual fund. Garib Indian is investing in mutual fund. That's a trend. That's a clear trend. 800 crores per month, 10 years back, to 8,000 crores per month. This is a trend. So I will latch on to trends, not to direction. So how to identify whether this is noise? My noise is somebody's important information. Whose important information? Traders के लिए बहुत important information मेरे लिए noise है. तो मैं trend की पकड़ रखूंगा. 3 trend पे हम bet करते हैं आज की date में. और to go through the long term, I have to use hedging mechanisms to go through these events. I can't ignore these events.
Absolutely. No, this is a very important observation on the mutual funds part. I would like to say that there is a structural change in the way money is lent to businesses in this country. Today, mutual funds have become a very important lender to different businesses, which is why investing through debt funds, one needs to be very, very careful, like you pointed out earlier. About 65% of the money in mutual funds, the assets under management, are in the form of money invested in debt instruments, G-Secs, short term, you name it, any of those things are there. So investing in debt should be understood very carefully because the risk there is much, much higher. We don't know what we are getting into. Ireland FS is a classic example which we keep referring to every now and then. So debt as a part of the portfolio, we need to be very careful because there is a huge structural change, and the trend that you suggested is happening in the industry. Out of the 8,000 crore that is coming in every month, I think approximately 30 to 35% goes into debt funds, and that is lent to businesses. Now we as individuals, are we investors or are we lenders? That's a question we need to ask. This is something debt fund managers won't like when I raise this question, is why and how do I know whether the person who is borrowing is a good borrower, bad borrower? Will the borrower return the money back? Even banks have not been able to control this. So while investing in debt, you need to ask this question and be very careful. The safest bet, of course, is the Government of India securities, where I guess your money is returned, but there is interest rate volatility risk is there. That's a trend that is changing. That's a very important thing. Therefore, you should ask this question. Debt is not 100% risk-free.
I just want to understand, as sir said correctly, as a senior citizen, suppose let's presume I have got 30-40 lakhs lying in a bank, okay, and kuch FDs mature ho gaye. So immediately RM of the bank will say, "Arey madam, 6-7 taka mil raha hai, do so and so." So definitely the way they talk, of course that's their job, you get convinced. So suppose I have 30 lakhs extra, as the person sitting on the dais, with due respect, can you please tell me how do I decide as a lady? अच्छा 5 लाख गोल्ड में डालूं, 5 FD में डालूं, हस्बैंड बोलेगा गोल्ड तो डेड इन्वेस्टमेंट है, ठीक है, बट एज एल्डर्स से कि वर्स्ट सिनारियो में उसको बेचोगे तो इमीडिएट कैश मिलेगा हाथ में, म्यूचुअल फंड कल का कल तो मेरे हिसाब से मेरे रेट्स पे तो नहीं बिकेगा. हाउ विल यू, रादर हाउ कैन यू गाइड मी honestly, how do I divide this amount?
Very good. See, that's exactly, I would, this example just helps me explain the advisor's problem. Because this 30 lakhs can be a part of total 60 lakhs. This 30 lakhs can be a part of 5 crores.
एंड आई एम सॉरी फॉर इंटरप्शन सर, मेरा एक और ये भी मसला है कि ये लोग जब घर आते हैं या बैंक में बुलाया जाता है हमें, इतना ब्यूटीफुल पिक्चर पेपर पे देते हैं कि आप फिदा हो जाओगे। 10 लाख मिल गया तो लंदन की टिकट तो आई जाएगी, साइट सीइंग भी हो जाएगा, ठीक है। घर आके आदमी सोचता है कि जब सच में मैंने म्यूचुअल फंड्स में डाला, माय हस्बैंड वाज वेरी हैप्पी, बहुत अच्छा किया, तब थोड़ी मोदी सरकार ने बोला था कि उस पर भी मैं तुम्हारा टैक्स कटेगा। इससे तो मेरी एफडी भली थी ना, 10 लाख की, जिसको तोड़ के मैंने म्यूचुअल फंड लिया, टैक्स तो वहां भी कट रहा है, तो वो क्या बुरा था। सो इट इज सो कंफ्यूजिंग फॉर अस एट दिस एज टू डिसाइड। कैन यू पुट सम लाइट ऑन दैट प्लीज?
सो अनफॉर्चुनेटली मैं आपको उतनी इंफॉर्मेशन से एडवाइस नहीं दे पाता जनरली, बिकॉज अगर मैं एडवाइस दे दूं ना, द चांस दैट माई एडवाइस इज रॉन्ग इज 70%. वाई? बिकॉज उतनी इंफॉर्मेशन के साथ, सी नाउ इफ आई से आधा पैसा शुड बी इन गोल्ड, लेट्स अज्यूम, if I, you will be very happy. That's why I said आधा पैसा in gold. I just so if I told you आधा पैसा gold में डाल दो, correct? Then you will put your 30 lakhs का 15 lakh in gold. 15 lakh I will say put it into deposits, hypothetically.
Both are safe.
Okay, both are safe. See, now what I will do, if I was a person who wants the 30 lakhs today, I will first gauge what does she love to hear, which took me a minute to gauge what you like to hear. I told you exactly both the things which you like to hear. Meri FD kya buri? You gave me a clue saying that what you love to hear. If I wanted the 30 lakhs from your bag today, the best chance for me to take that 30 lakhs is what? Tell you exactly what you love to hear. And then you'll give me the money. Right? But the right thing to do is, if you already have 50 lakhs of gold, then I'll say, madam, you need at least 30% in equity. तो आप बोलेंगे यार 30%. So first I have to check आपके बाकी पैसे कहां लगे हुए हैं. उसके बगैर अगर मैं ये एडवाइस दे दूं ना, then I have been a lachi person trying to get the 30 lakhs by just telling what the client needs to hear, wants to hear, but not what he wants to, what he should be buying. My job will be so much tougher to convince her that your 30% money should be in equity. It's not going to be easy, but I have not chosen an easy job. As a wealth manager, I can't make my job easier. So I have to tell you, madam, if you have 70% in deposit, 30% in equity, दुनिया इधर की इधर हो जाए, equity आधा भी हो जाए, तो भी आपकी कैपिटल पे आंच नहीं आने वाली.
So in short, I mean, investing little bit, whatever percent is 10 or 20 in gold is also not a bad idea.
Yeah, I think it's been a great session. Feroze, thank you so much. Thank you, ladies and gentlemen, for patiently listening to our from BTVI, wishing you all the best. Save, invest, and prosper, and wishing you a Merry Christmas and a Happy New Year.